Good evening, guys. Can you see my screen? Hello, anybody there? Okay. What is the time? It's 4:02. How much time do you think we should wait before we start? Ritika, Mansi, Akshata, were you in the first session? I remember Path was there. Oops. Participants. Hi, Vaibhavi. I remember you were there last time. Two Sarthaks here. Good evening. Can anybody tell me what were the services offered by an investment bank to their clients? And can you please unmute yourself and say something rather than writing on the chat? Yes, mergers and acquisitions. What else? List IPO. Okay. Listing of IPO comes when? Is it, do you start with listing or do you start with some other activity? Does anybody remember the name of the firm which did the IPO? Does anybody remember the name? No? Okay, so the main function of an investment banker is to help businesses, mainly companies, to raise funds via equity by issue of equity shares or by issue of debt securities. Okay, uh, the other services provided of surplus funds of clients, mergers and acquisitions, spin-offs, sales of business. These are some of the other services that are provided by an investment banker. And as we discussed last time, investment banking is a part of the entire financial services industry. It is a very specialized section of the industry. And if you recall, we discussed that financial services basically takes money from households, the government, and companies which have surplus funds, and they give it to households, companies, and governments where there is a deficit who require funds for their business or for their consumption, right? So whether it is a bank does it by offering account services to customers. So you can open a savings account, or you can open a fixed deposit, or you can open a current account, and the money that you deposit in your account, some of it is kept as cash reserve ratio, but almost 80% of it is then used by the bank to give loans to other customers who require it. And the difference between the interest that they receive and the interest that they pay is the gross income of the bank. Similarly, mutual funds and insurance companies, they take funds from customers, and they provide different mutual fund schemes where you can choose whether you want to invest in equities, whether you want to invest in fixed income securities. And based on the investment objective of the scheme, the funds are invested and divested, and the returns are then provided to to their clients by way of increase in the NAV of the scheme, right? So in this session today, we are going to discuss the equity markets and the bond markets, right? Again, financial markets, financial institutions, financial products, and regulators, these are all a part of the financial services industry. Okay, so there are bond markets, there are players, institutions like mutual funds, like brokers, insurance companies, banks, uh, investment managers, all kinds of different financial entities are there offering different kinds of services. There are products. So products is a mutual fund scheme or an insurance scheme or an AIF or a PMS. So these are products. Then because these companies are taking money from the public, they are heavily regulated. The government ensures that not everybody can come in and enter this business. So there is a licensing process. SEBI and RBI are the two major regulators, and even IRDA to a certain extent. IRDA is the regulator of general insurance companies, life insurance companies, and health insurance companies. SEBI is the regulator of mutual funds, PMS, AIFs. Plus, they regulate all the companies who want to do IPOs and who want to list their securities on a stock exchange. And you have the Reserve Bank of India, which is the regulator and the license issuer for banks and NBFCs, right? So these regulators, their job is to ensure that everybody works according to rules and regulations. It's not a free market. Just nobody can just come in and start doing business from tomorrow. There is an application process. There is a due diligence process that each regulator follows, followed by a license which is then issued for doing that particular business. And thereafter, there is continuous monitoring by way of reports and MIS that are filed with the regulators. And they, in fact, send auditors. There are audits done on an annual or a biannual basis to determine whether each financial services entity is following the rules that they are supposed to follow. And if they don't, the fines and penalties and punishments that are meted out to these companies. And to a certain extent, there could even be their licenses could also be taken away and they would be out of business, right? So I think with that, let's turn to today's session on equity and bond markets. Um, Please let me know if you are not able to see my slides. So these are the learning objectives for today. We will understand all the elements of a financial system. We will look at the sources and processes of fundraising. We'll list the steps in an initial public offering. And we will explore corporate bonds as a means of fundraising, right? Like I had mentioned last time, there is a case study which we had again discussed last time. And there is the same case study which is applicable for today's session. I'm not sure whether any of you have read this case study. So I want to request one of you, if you can, aloud for all of us. Will somebody volunteer, please? Do I have a volunteer? Sneha Pandey, can you hear me? Sneha? Sneha, will you be able to read the case study? Yes, no? Something in the chat. Mansi, will you be able to do this? Mansi, are you there? Okay. I don't think any of you guys are volunteering, so let me just read it myself. Somebody's on the chat saying I can. Yes, go ahead, Vaibhavi. Thank you so much.
Should I start?
Yes, please.
Previous lesson, we briefly viewed how stringency advisory provided finance, uh, finan- financial advisory services to Freshers Foods International at various points in its journey. In this lesson, let's delve into it a bit deeper. Let's start from the very beginning when Freshers Foods was just an idea in the minds of two friends, Freda, a banker working with a global bank, and Kshitij, a chief at leading five-star hotel in Mumbai. In the year 2004, Frida and Kshitij, along with some of their friends, were on a back, backpacking holiday through Europe. When they when they chanced to visit Snacks Snacks
Snackex.
Snackex, the international trade fair for savory snacks and nuts that was being held in Bruce
Brussels.
Brussels,
Brussels.
Brussels.
Brussels, capital of Belgium. Yeah, go ahead.
ये Brussels. Snacks is the only 100% focused savory snacks and snack nut international trade fair in the world, but there was hardly an Indian participation. This set them thinking India had such wide variety of savory snacks that few countries in the world could rival. Still, we had minimal global presence and we were not poised to take advantage of the developments happening in the production, processing, and packaging of savory snacks.
Yeah, go ahead.
Thus was born the dream of setting up Freshers Foods International Limited, which would one day go on to become one of India's India's largest fast-moving consumer goods companies. Even the best of ideas need funds, so Freda and Kshitij the pool in their savings. However, that was not enough to set up a state-of-the-art manufacturing unit, so they decided to reach out to family and friends to invest to their startup. Two of their friends from their backpacking group, Angelina and Aledrineth, were keen to pitch in. These two friends invested in the business based on their trust in Freda and Kshitij. The two friends in the context note that angel money is not but an investment in the business. The promoters and the angel investors raise INR 5 crore seed fund. The seed fund referred to the initial funding provided to a business off the ground. The original four promoters, Freda and Kshitij, plus two share certificates of the company in exchange for their first seed investment, entitling them to ownership. The process of issuing shares is pretty straightforward. Freshers, Freshers Foods International considered each share to be worth rupees 10, and since rupees 5 crore was the share capital, 50 lakh shares 50 lakh shares were issued. In this context, rupees 10 is referred to as the share's face value. Any number, any number could be the face value. The number of shares would be 1 crore if the face value was rupees 5, and so on. With the help of the seed money, the promoters launch the company. They take cautious steps, make the correct hiring, set the proper procedure, and then begins producing luxury and artisanal wear. Saviors. To begin with them, they only operate a single modest production facility and one retail location. Their efforts are rewarded and the company generates a consistent flow of income. And the conclusion of the first 2 years in business, the company begins to break even. Now intend to grow the company by establishing a couple more retail locations and another manufacturing facility in the city. They plan out the strategy and determine that INR 7 crore is the new investment required for business growth. Now, the Frisch's Foods founders would find investors who were fairly knowledgeable and willingly to invest in the company. The money the company received at this point is known as Series A funding. And the investor who normally makes an investment at this early stage of the business is known as venture capitalist. 3 more years, the business achieves incredible success. The business chooses to open stores in at least 3 more cities. The company intends to enhance its production capacity and add more personnel personnel to support the retail presence spread across 3 cities. The term capital expenditure or simply capex wants to make to enhance its overall operations. The management says 40 crore in capex expenditures. How does how does the business obtain this funding, or how does it capex needs? The business has a few choices for raising the money needed for capex. A portion of capex can be recovered by the company's recent gains, which have helped it to turn a profit. Alternatively, known as funding through internal accruals. By allocating shares, the company can approach a different VC and secure
VC.
a VC and secure a
Second round.
second round of VC money. This is known as the Series B funding. The business may the business may ask a bank for a loan. The company has been performing reasonably well, so the bank would be pleased to offer this loan. Another of the loan is debt. Assume that the business uses all 3 avenues to raise money for capital expenditures. It invests 15 crores from internal accruals, plans a Series B, and sells some shares to another venture capitalist for 10 crores, raising 15 crores in debt. As the firm profit increases over the following few years, aspirations increase. The company is only 8 years old. The business makes the decision to raise the bar and expand across the nation. They further diversify the business by producing and selling cookies, confectioners, and chocolates. The current the current estimate for the capex needed to support the new global is 60 crore. The, the corporation does not want to borrow money through debt because doing so would reduce its profits due to the burden of paying interest rates and commonly known as finance charges. The business chooses Series C funding since normal VC capital is typically modest and only amounts to a few crores. They are unable to approach a private equity PE investors enters the scene at this point. Fast forward after the PE investment 5 years ago, the company has made good success. They have a presence in all of the main cities around the nation and have successful broadened their product line. The investors are satisfied and revenues are revenues and profitability are both strong. The promoter though intend to stop there. The promoter now has international ambitions. The business now wants to brand to the accessible in all major international cities to comprehend the demographics of other nations, invest in personal and expand industrial capabilities. The corporation must invest in market research. Additionally, they also need to invest in global real estate. The management projects a 200 crore capex requirement, which is enormous. The business decides to finance some of the capex with internal accruals and the remainder via IPO. A corporation must make its shares available to the public when it files for an IPO. The general public will pay a set amount to subscribe to the shares, that is, if they wish to. It is now referred to as the initial public offer because the company is offering the shares to the public for the first time. As we have seen earlier, the investment banker's responsibility would be to help the company with the numerous IPO related tasks. After considering various options, the Freshers Foods management finalized Stringency Advisory Private Limited as the investment banker to, to be the lead manager to their IPO. The Stringency team took, took charge and executed the next step as follows. Apply with a registration statement. The registration statement provides information on the business operations, reasons for wanting to go public and financial standing. Second, obtain approval from SEBI. SEBI decides whether to give the IPO the go ahead or the no go after receiving the registration statement. Prepare the draft red herring prospectus DRHP. The DRHP is a document that is shared with the general public. The following information should be included in DRHP along with a lot of other information. A. The anticipated IPO size, the anticipated quantity of shares being made available to the public, why the company wants to go public, how the company plans to use the funds, and an estimated time scale for fund use. This for the business, including the revenue model and financial information, financial statements in full, discussion and analysis of management, how the organization anticipates future business operations to develop, risk associated with the industry, information about management and their history. The IPO details, the IPO date, uh, promote the IPO. This would entail running TV and print ads to raise awareness of the business and its IPO offering. The IPO roadshow is another name. Determine the price range within which the company would like to go public by fixing the brand band. Of course, this cannot be that far off from the general assessment of the share price. If so, the public won't buy shares in the IPO. The IPO was subscribed 28 times on November 7, 2012 closure. After analyzing the application forms received and evaluating the bid prices in the range 295 to 310, the Stringency Capital team found that the optimum price to be 300. Now, on November 16, Freshers Foods International was listed on the stock exchange. This whole system is referred to as the primary around the date of the issue, where one bids for shares. The moment the stock gets listed and debuts on the stock exchange, the stock starts to trade publicly. This is called the secondary market. In the secondary market, the stock was bought and sold in large volumes on a daily basis. This is a glimpse of the stock price movement and trades over the initial few days. As as we decide as we had discussed earlier, Stringency Capital had provided a whole range of investment banking services to Freshers Foods. We shall explore each of these in the upcoming lessons. For now, let's fast forward to 2020 corporate bond issue. A bond is a obligation like an IOU. Investors who buy corporate bonds are lending money to the company issuing the bond. In return, the company makes a legal commitment to pay interest on the principal and to return the principal with the bond comes due or matures. In 2020, Freshers Foods International decided to start separate venture to manufacture an artisanal chocolates under the name Le Chiffrette Chalks, for which it preferred not using the resources of the parent company. As a result, it issued corporate bonds in the name of the company Le Chiffrette Chalks. As investors knew that parent company Freshers Foods International is a trustworthy market entity, they invested in the bonds for 2 to 3 years. Leishfre Chalks uh, used the funds to grow its business while paying the interest timely. Finally, it repaid the bondholders respectively after 2 years.
Great. Thank you, Vaibhavi. Thank you so much. I would have got tired reading all of that. So as you can see, this is a very good summary of, how businesses generally start. You might all have heard that HP, the large PC company, Google, Apple, these were all started in some garage in the US. And this is how even, in fact, Freshers Foods International, the idea was born when two friends went to Europe on a holiday, and they went to a fair and they realized that there is no Indian brand which is participating in that fair. So they went back, they did some more research, and they came up with an idea. And then, of course, you need money, because if you're going to set up a manufacturing facility to manufacture something, you need to buy land, or you need to at least rent a factory and then install plant and machinery, employ people who will do the manufacturing, people who will source raw material for you, who will then arrange for logistics, do the marketing. So all of that stuff. So Precious Foods, Freda and Shitij, they found two of their friends, Angel and the other fellow, who played the role of angel investors. So angel investors or angel investing is typically very, very high risk kind of investing, because there is nothing to really review, right? So if you see this example, Freshers Foods first raised 5 crores from the angel investors, then they raised 7 crores through Series A funding from a venture capital, then they raised another amount for Series B funding, then they raised another amount of 40 crores through a bank loan and Series C funding. So these are different levels of funding that happen, and the more the funding requirements, the more established the business is. It has been around for some time, so there is a track record. You can see what has happened, what was its expenditure in each of the last 3-4 financial years, what were its revenues, what is its products looking like, how many customers do they have. You can actually taste their product in this case, because it's a food item, right? You can visit their retail shop. If you're an investor, you can visit their retail shop. So in all of this funding, you are talking to third parties. You are no longer talking to your friends and family who know you for a very long period of time, who trust you. They know what your strengths and weaknesses are, and they are willing to give you their money because they believe in you. They believe in your capacity to take your idea, to implement your idea and make some money. So that's why they are called angel investors. But thereafter, getting money from an IPO is still difficult. And therefore, again, this is another part of the financial industry called venture capital industry and angel investing, where third party people, where there are specialized fund managers who raise money from, again, investors who have surplus funds and who are willing to take a higher risk. Company out of 10 that
Recording in progress.
Jesus Christ. Can you hear me now? Guys, you need to unmute and tell me. I was talking so much and I didn't even realize that I was on mute till I saw your messages. Please unmute and tell me. I don't even know when I was on mute. Okay, so where I was on mute from 4:45 p.m. It is now 4:47. So is it just for 2 minutes that I was on mute? What was I saying last that you guys heard? Okay, so let me just recap. I was saying that we looked at the journey of Freshers Foods. It was a startup. When you are raising money from your friends and family, there is no real formal process required. You don't really have to document your plans, your past performance. But when you're talking to venture capital, when you're talking to private equity, they are not your friends and family. They don't know you. And that's where you need intermediaries like an investment banker. An investment banker will come in, they will study your business, they will get a lot of data, they will put it in a nice presentation, in a nice document called a prospectus, which they will then share with different venture capital investors, and they will go and convince them as to why they should be investing in this business. So that's how that entire deal happens. And Freshers Foods went through almost 2-3 rounds of fundraising before they required an amount of 200 crores to take their business to different countries. And that's when they decided to do an IPO, which is issuing shares to the general public, and also giving an exit to people who had invested with them earlier. All those venture capitals and the angel investors, they would want to sell off some of their shares. So taking the company public makes sense because then your shares are listed on the exchange and everybody is free to sell and buy on the exchange, right? So till your shares are listed on the stock exchange, there is no way that you can buy and sell shares unless you need to go and find somebody who will buy the shares from you, right? So when you want to do a public issue, that's when SEBI steps in, because as I mentioned earlier, the role of the regulators is to ensure that people don't run away, companies don't run away with the funds of the public, right? So you need to file a prospectus with SEBI. They will review the prospectus. Of course, they are not going to comment on things like the pricing and stuff like that, but they will go through the prospectus to ensure that you are disclosing all the relevant information. And the prospectus itself will be prepared by one of the investment bankers, right? So that will happen. And thereafter, the pricing is determined and, the issue is launched and people have a chance to apply. And then at the end of the IPO period, you look at whether there is an excess demand or a less demand, and you decide on the pricing and you allot shares, and the share is then listed and it can be traded. Okay, so that's how it works. Now let's get back to the slides and go forward. So these are the elements of a financial system or a financial services industry. Financial markets. What are those markets? Markets is where you can buy and sell shares, where you can buy and sell debt instruments. So these are typically over-the-counter markets, or these are typically stock exchanges where you can, or debt security exchanges where you can buy and sell equity and debt securities, right? Financial institutions, again, are examples are banks, non-banking financial companies, mutual funds, insurance companies, both health, life, general, brokers who are attached to a stock market. the stock markets themselves, because these are owned by companies. Today, the Bombay Stock Exchange is owned by BSE Limited, which is again listed on the stock market. National Stock Exchange, which is a larger equity market, is owned by NSE, but it's not really listed so far. Then you have financial assets and instruments. We discussed this. These are mutual funds, insurance policies, shares, debentures. So all of those are financial market assets. So you actually are buying, investing in these financial assets and instruments which are issued by this financial institutions and which are traded on the financial markets, right? And all of these three, and there is of course regulators, okay, which is not included here, but all four of these comprise what we call financial systems or financial services. Going forward, we spoke about this. A financial market is a collection of procedures and activities that are typically governed by rules and regulations to allow players to trade in financial goods and instruments, right? What is a financial goods and instrument? Insurance policies, mutual funds, shares, debentures. What is the fair value of these instruments? You can only find this share value on stock exchanges. What is the price of the share of Reliance Industries? It changes every day. In fact, it changes every minute. Of course, it doesn't really change drastically. It could be traded between 1400 and 1425 rupees during a day, and then it closes at a particular price. So the closing price of any share is an average of all the transactions that have happened in the last half an hour of trading. Okay, so that's the closing price, which is then used to value this instruments. Okay, so what are the two ways in which you can raise capital, right? One way is, of course, through raising equity. Equity raising is the process of exchanging a portion of a company's ownership for funding. So you're actually selling a part of your company to third party because you need the funds to invest in your business. Okay. Can anybody tell me what is the return that an investor in equity gets, and what is the return that an investor in a debt get? So we looked at Fresh's Foods, where they issued a bond and they also took a loan from a bank, and they also issued shares. They took funding from various venture capital firms, and then they did a retail issue. So what do you get when you invest in a bond? What would you guys invest in tomorrow once you start earning? Now I've become smarter. I'll only look at the chats. Yes, anybody? Nobody has an answer? So when you invest in a bond, or when you invest in an FD, or when you give a loan to somebody, you are looking at a fixed rate of return called an interest rate that you will get paid every year. So let's say you invested in a bond, you gave a loan to Freshers Foods of 1 lakh rupees for 3 years at 8% per annum. So at the end of 1 year, Freshers Foods will give you 8% of 1 lakh, which is 8,000 rupees as interest. Then again, at the end of second year, you will get another 8,000 rupees as interest. And in the third year, at the end of the third year, you'll get your original 1 lakh rupee back plus the 8,000 rupees as interest. Okay. So there is no uncertainty as regards the amount of interest and the amount of capital that you will get. All of these things are certain, right? The only uncertain thing is that will Freshers Foods survive for 3 years and give you that money? So that is called credit risk. Okay. So you're taking a credit risk when you're lending money to somebody, because what amount you are going to get back is already agreed before you gave the loan. But the same is not true when you're giving money as equity. When you're giving equity, right, there is no fixed return you are going to get, because it depends on the profit of the company. So the return that you can get is only by way of two ways. One is, you bought the share for, let's say 100 rupees. You bought 1,000 shares of Freshers Foods at 100 rupees. So now you have invested 1 lakh in equity, and previously you had invested 1 lakh in debt, right? My camera on. Oops. Yeah. So on the 1 lakh that you invested in debt, you will get your 8,000 rupees every year. And at the end of 3 years, you will get your 1 lakh back. What will you get on equity? You don't know. You can't say. So if the company makes money and they have made a profit and they don't need the money to invest in their business, then yes, Sujal, you're absolutely right. You get capital gain. But how do you get capital gain? Do you know that? How do you get capital gain? Right? So you raise money, you get, if the company makes profit, they will declare a dividend. And the dividend is, they will say, okay, I have made a profit of 10 rupees a share. So out of 10 rupees a share, I will give 3 rupees as dividend to all my shareholders. 7 rupees I will keep for investing in my business or investing in new opportunities. So that is what is called internal accruals. So they are keeping a part of the profit and they are investing in the business. So one of the scenarios of Freshers Foods was that 40 crore funding, where they said we will take a loan from a bank, we will use internal accruals, and we will also do Series C funding, right? So again, you will need an investment banker who will go and talk to the venture capital to give you Series C funding. So equity, because it is uncertain, right? Because nothing is fixed. And because it is not fixed, it is uncertain. Okay. You have invested 1 lakh. You don't know how much dividend you're going to get. You don't even know whether your 1 lakh will become 1,10,000 or will it become 90,000. So that is the risk. And because of this risk, you will want a return which is more than 8%. Okay. If you don't get a return of more than 8%, you would rather invest in debt. If the equity is going to, if you know that the equity is going to give you only a 6% return, which is via dividends and capital gain, you will say, I don't want to invest in this equity. I would rather invest in the debt, because that will give me a 8% return, right? So equity, you will only invest if you are going to get a return of 12% or 14% or 15%. How are you going to get that 12%, 14%, 15% return? Maybe you will get 1% as dividend every year. And let's say at the end of 3 years, the company's share has got listed. Okay, the price in the market is now 150 rupees. So you invested 100 rupees. So you got a 50 rupee capital gain. Okay, 50 rupee over capital gain over 3 years is roughly, 14% on a CAGR basis. So you got a 14% return, which is more than the 8% return, right? So that's why you invest in equity. And because you are expecting a higher return from equity, that translates into a cost for the company. So for the company, for it to give you a 14% return, it has to generate that much more profit, right? It would rather pay a 8% interest on 100 rupees rather than a 14% interest on 100 rupees. Okay. So that is why companies will always raise debt. But there's a limit to which you can raise debt. Okay. If a company has got 100 rupees of equity, you will give maybe 150 rupees or 200 rupees as debt. Remember the financial ratio of what is the debt equity ratio? An ideal ratio is 2:1, right? Because the people who are giving you debt, they will say that boss, pura risk मैं ही ले रहा हूँ, तुम क्या risk ले रहे हो? Okay, where is your money in this business? Okay, because tomorrow if the company doesn't work properly or the business is not becoming profitable, owner will say, sorry, I have invested only 100 rupees in the business, but you guys have invested 400 rupees, तो आप लोग देख लो आपको क्या करना है, मैं तो चला. Okay, so that is why equity is riskier and requires a higher return than debt. Okay, but who are the people who invest in debt and who are the people who invest in equity? It's simple. Everybody has surplus, right? Financial services industry का काम क्या है? जिन लोगों के पास excess money है, उनसे पैसा लेके to give them an avenue to invest in debt or equity. So people who are risk averse, who don't want to take too much risk, they will invest in fixed income securities like loans, FDs. But those who are not happy with the return given by a fixed income instrument, those who want to take more risk, those who can invest over a longer period of time, they can afford to invest in equities, right? So that is the primary difference between a debt and an equity instrument. And the reason why companies will always, raise more debt compared to equity. But investors, even those who are giving equity or those who are giving debt, will say there needs to be a balance between these two sources of funding. Okay. Moving ahead. These are the different stages where angel investors come in, where venture capital come in, where private equity comes in. So at the founding startup pre-revenue stage, what do you mean by pre-revenue? धंधा कुछ नहीं हो रहा है, कुछ माल ही नहीं है बेचने के लिए. ओके, बट पैसा चाहिए ना, आइडिया है दिमाग में, फैक्ट्री सेटअप करने का है, फैक्ट्री सेटअप करोगे, माल बनाओगे, that's when you will start earning revenue. So this is where the risk is the highest. Therefore, angel investors come in, but the size of investments is quite small. It could be, from $10,000 to a few million, right? And once you become larger, once you need more money, you want to expand your business, you are still not profitable. Okay, but business is happening. Maal ban raha hai, product is being manufactured or the service is being delivered. There are customers, the service is good, customers are growing, but you're still not profitable and you need scale. So if you sell more to more number of customers, the margin that you will make will then cover your overhead. So that's when you need more funds. So that's when the venture capital comes in. And then thereafter, when you want to expand even further, is when private equity comes in. Okay, you're profitable, but you still need more money. Now, if you're profitable and if you're not investing in the business, then you don't need funds, right? You have become profitable, but now you want to make even more profits by expanding your business. Okay, from 50,000 customers, you want to go to 500,000 customers, and then maybe you want to take it even further to 50 lakh customers. So that's when you need private equity, or you will in fact even contemplate doing a IPO. Okay. So when you're doing an IPO, that's when you are taking your company to everybody. So you're marketing your equity to almost everybody who's eligible to invest in the primary market. So there are different ways in which you can do public issues. So of course, the first time when you do it is called a IPO. It's called an initial public offer. Okay, you're a private company, right? You had friends and family and some venture capital investors as your shareholders, and now, from 500 shareholders, you want to go to 50,000 shareholders or 5 lakh shareholders or whatever it may be. And that's when you offer, you do advertisements on TV, you do a full page advertisement on Economic Times, Mint, Hindustan Times, all the business newspapers. You give advertisements. Why are you doing that? Because you are advertising the fact that you are doing a public issue. People should know, they should study your prospectus. You go and do road shows. So what is a road show? Road show is when the company and the fund manager and not the fund manager, the investment banker along with the company's management, they go and meet various wealth management companies or various brokers, okay, who have customers who are who will invest in the public issue. So they will go and tell them that, this is our company, this is our business, this has been our profitability in the past, these are our plans going forward. We are going to, our expectation is that our market share will be so much, and therefore, this is the justification for the price, and you can expect a return of anywhere from 13 to 16% on this investment going forward. Okay, so that's how more and more people will apply for the IPO. And a follow-on public offer is when you need even more funds going forward. Let's say you want to acquire a company, or you want to get into a different business altogether. So we saw in Freshers Foods, they said, okay, we were in savory snacks, now we will start manufacturing artisanal chocolates. So these are like, very high-end designer made chocolates, which again requires an investment. So again, you will do a follow-on public offer, and there are various ways in which you can do a follow-on public offer, which we will discuss in the next slide. Okay, so one way in which you can do a follow-on public offer is through a rights issue. So what is a rights issue? You already have your 50,000 investors, and you're saying, okay, आपने मेरे को इतना पैसा दिया है, but I need more money. So I want to issue, let's say, 10,000 shares more. Okay, so for every 10 shares, you offer them 2 shares more. So you say, okay, you are already owning 10 of my shares. I'm offering you, please buy 2 more shares of mine at this price. Okay, and again, here is the prospectus, here is what I've done in the past, here is my plan going forward. So all of that is required, and therefore there is a time period. You send the offer letter to all your shareholders, and you say, by this date, you need to come back to me whether you're buying it or not. Okay, so that's a right issue. So it's not compulsory. If you are a shareholder and the company sends you a rights issue application, you may choose not to invest in the same, right? A bonus issue is a very different issue. A bonus issue is when a company doesn't need funds, but they just want to reduce the price of their shares. So let's say they issued shares at 100 rupees, right? And after 5 years, they find that the price of the share has become 1,000 rupees. So what they will do is they will announce a bonus issue, where they'll say for every 1 share that has already been issued, we'll issue another share to the existing shareholder free of cost. Okay. So what happens when a bonus issue is issued is, when a bonus share is done, is that if there were 50,000 shares in the market, now there will be 1 lakh shares. Okay. The value of the company remains the same. Okay. So 1 lakh, 50,000 shares into 1,000 was the value of the company. And now you are issuing 1 lakh shares. So typically the price of the share has to come down to 500 rupees. Why? Because now there are double the shares, so the price has to become half. Okay. So when the price becomes half, more people think कि अभी ये शेयर प्राइस सस्ता हो गया है, इसलिए इसको हम लोग ले सकते हैं. बट एक्चुअली वो सस्ता कुछ नहीं हुआ है. ओके, जो 1,000 रुपए का भाव है, वो अभी 1 लाख रुपए में 1 लाख शेयर्स के ऊपर डिवाइड करोगे तो उसका भाव 500 होना चाहिए. सो डोंट बी अंडर द इम्प्रेशन दैट आफ्टर अ बोनस इश्यू shares have become cheaper. They have not become cheaper. Okay, it's a misconception, right? So that is what a bonus issue does. You can also do a private placement. So what is a private placement? Is you say that I don't want to do a public issue, that is making an offer to public again. I don't want to do a rights issue. A rights issue is to to your existing shareholders. Let's say I want to bring in a very specialized party, let's say a retail chain, like a chocolate retail chain. I want to bring them in as my partner, and so they are going to make an investment. So I'll do a private placement of shares only to that entity. So that is called a private placement. So either you could do it to a strategic partner, or you could do it to a few small investors who are just financial investors. So they are not in the business of chocolate or retailing or whatever, or snacks or all that. They're just financial investors, and you think having them on your as your shareholders will be very important. So you can do a private placement to these investors. Okay, let's move forward. What else can you do? So as we discussed, debt financing is essentially where a company takes a loan, and the reason they take a loan is because from their perspective, it is a cheaper way to do business or a cheaper source of funding than equity, right? And we discussed that a debt you can give an 8% interest, plus you can claim that 8% interest in your taxable income as a deduction. So it is a reduction from your revenues. And after paying interest only, you arrive at profits on which you pay tax. Okay, and you pay tax. So what is called, it is called profit before tax, then tax comes, and then profit after tax, and you pay dividend from profit after tax, right? So 8% is like your pre-tax cost. If you deduct the tax that you save of, let's say 30%, so 8% is 8%, 30% of 8% is how much? 2.4. So your net interest cost is only 5.6%, right? Let's go to the next slide. So you can take an interest from a bank. Typically, we do that from a bank or from a NBFC, where we take a loan and we pay interest, right? So corporates also take a loan. They start off by taking loan from banks and from non-banking financial companies. They will typically do a bond issue when they are very profitable, when they are well known, and they believe a lot of people will come in. A lot of financial investors like mutual funds and life insurance companies will buy their securities. Okay, so again, they will do a private placement of a debt security. They don't have to do a retail issue or a public issue. They can do a private placement to mutual funds and insurance companies, and even sometimes to banks and other large investors. They are generally called qualified institutional buyers, or QIBs in short. Okay, and typically these bonds also have a coupon. They have a fixed maturity period and whatnot, right? So that's how it works. And this is, I think, the last slide of this presentation, where here is the IPO process. So you decide you want to broad base your shareholders, you want to, give the common man on the street the chance to own your share and become rich with you as you go along. So you decide to do an IPO of issuing shares to the public. So this is how it works. You decide that you want to do an IPO. So you will say that, okay, I already have issued 1 lakh shares. Remember that 1 lakh shares, but I will now issue 25,000 shares to the public. Okay. Again, there are some SEBI rules which say that the promoter needs to hold less than 75% of the company post the issue. So then accordingly the size of the issue is decided. So if it is 75%, then probably they will have to issue something like 130,000 odd shares, so that from the post issue capital of 1,30,000, they have to own less than 75%, right? So you will decide this. You will hire an investment banker, which is the underwriting selection. You will assemble a team of lawyers, of the investment banker, of people who will do marketing. You will need a registrar and transfer agent who will process all the applications, who will then allot shares to all the eligible applications, who will refund monies. Of course, some of these things have become simpler now because they have brought in things like ASBA. How many of you know what ASBA is? Okay. Since you guys are not so great at responding, I will answer that question myself. ASBA stands for application supported by blocked amount. Okay. So earlier you had to actually transfer funds from your account to the account of the merchant banker or to the account of the company. Application to supported account. Yeah, absolutely, Sujal. So the way it works is you fund your account. So let's say you're applying for a company, and typically retail investors are those who can invest up to 2 lakhs, right? So let's say you want to invest the entire 2 lakhs in an IPO. So you ensure that you have 2 lakhs in your bank account, and you make an application to the company. So they will actually block 2 lakhs in your bank account. So you will not be able to use that 2 lakhs till the entire issue process is completed. Okay. So let's say like it happened in the last week's IPO, Tata Technologies, you could apply for something like 350 shares. Okay. I filed an application for my mother. We made an application for 350 shares, but actually we got only 30 odd shares. And, so 30 odd shares, and I think the IPO price was 300 rupees or something like that. I don't remember the exact number, but let's say it was 300 rupees. So 30 shares at 300 means 9,000 rupees. So they will only debit 9,000 from the account, and the balance 1,91,000 will be released. So now you can use it for making payments or investing it somewhere else. So that is how ASBA works. So you need to put that in place. Then you, of course, step 4 is filing the draft red herring prospectus with SEBI. It is written SEC here, but SEC is the US regulator. Okay, our regulator is SEBI. So you need to file the DRHP with SEBI, and then SEBI will discuss or ask for some more information from the investment banker. And the investment banker will, give those clarifications to SEBI, and then SEBI will say, okay, you can go ahead and do the issue. And that's when you start marketing the issue. As I said, you need to go and speak to all those big guys in the market who will then go and sell it to all the small guys. Okay, so that's the marketing, because nobody's going to come and meet you personally and say, okay, sir, aap hamare company ka shares le lo. Okay. And now typically, they give a range of pricing. So the price range is, let's say, in case of Tata Technologies, let's say it was 290 to 300 rupees or something like that. So you can, as an investor, you can choose at which price you want to buy. Okay. Typically, there is another option called cutoff price. So whatever price is the cutoff price is, you can choose that option. So whatever is the final price determined by the banker, you will be issued shares at that price. Okay. So at the end of the issue, they will see typically if there is a huge oversubscription, then shares are always issued at the highest price in the band, right? And within a period of 2 days from the end of the IPO, the shares are listed, and quotes start happening on the screen, right? So if you want to buy more shares, then you can go and buy more shares, or if you want to sell the shares that you got in the IPO, then you can go and offer those shares for sale. And thereafter, the company has to sign a listing agreement with the stock exchange. So listing agreement requires the company to do various things. So things like, if there is anything important that happens in the company, they need to immediately inform the exchange so that the exchange can disseminate all that data or the information to everybody, so that everybody has the same amount of information at the same time. So nobody has got an information advantage. Okay, so one of the requirements or one of the objectives of SEBI is to ensure there is fairness in the market. So what is fairness? That everybody should have the same data at the same point of time. There should be no leakage of information, or nobody should have an information advantage. And that is why during quarterly reporting periods, companies, there are strict rules on insider trading. So a company's management can't buy and sell its shares based on this advantage. If you are an employee of a company, you will always have an advantage. You know more about the company than anybody else, obviously. I always knew more about the companies that I worked for than I knew about other companies which I used to invest in. Okay, so you always know more, and therefore there are these rules in place which say that when you can buy, if you buy a share, then you can't sell for 6 months. Okay, so if there is a rule, if I know that the company is going to announce a new strategic partnership, then I'll buy the share. Okay, so that is insider trading. So there are rules which say that company employees cannot buy and sell shares during a particular period. And if you violate those rules, you could be penalized. You could even lose your job, right? So companies then have to follow the requirements of this listing agreement. Typically, there are rules which say that within 45 days of the end of the quarter, or within 60 days of the end of the quarter, you're supposed to disclose your unaudited financial statements to the stock exchange. Okay, you need to disclose other information, as I've already mentioned. And at the end of the year, you have to complete your entire audit and all that again within a specific period of time and inform them. So it becomes more onerous. The regulatory requirement changes after you become a public company. Okay, so then who are your directors? You need to have directors. Your promoted directors have to be lower. Your directors have to be more. You need to have an audit committee. You need to have a share issuance committee. All kinds of rules and regulations come into place, right? So it is typically your cost of running the business goes up. So you need to carefully evaluate that, are you doing the right decision when you are doing a IPO, right? So I think that is the end of the slide or end of the presentation. Now we go to the more interesting part, which is this quiz. तो प्लीज आप लोगों का मोबाइल फोन निकालिए, हम लोग क्विज खेलेंगे. Let me go to the quiz part. Oops, that was the wrong thing to do. इसको बंद कर देता है, इसका कुछ काम नहीं है अभी. गलती से मैंने वो बंद कर दिया. Undo close tab. Shit. Anyway, let me Yes. If you have any questions, please put it in the chat. This is module 1, part 2.